And now, The Money Show with Motheo Khoaripe
on 702. Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud to support Genza Energy's investment in the infrastructure powering West Africa's growth. Good evening and welcome to the Thursday edition of The Money Show. News breaking then that Sasol Natref refinery shut down affecting OR Tambo International. We'll be definitely covering that for you if you're heading to the airport. Dr Guy Leitch, aviation analyst, will tell us more about that particular fuel disruption. And then the IDC booking a 4.6 billion rand loss for the 2026 financial year. But you know, with them, it's not only about profits, it's also about funding businesses and industrialization in the country. We'll be talking to CEO Mmakgoshi Lekhethe about their latest results. Then later on the show, our markets commentary with Graham Kerner from Kerner Perspective, talking about NVIDIA, that tech share boosting US shares this afternoon, but things are a little weaker on the JSE this afternoon. So we'll be dicing down those numbers. Truwords are talking about weaker sales over this particular period, saying, consumers, you and I, not opening our pockets, not opening our wallets and purses to buy new clothes. And they've been suffering as a result. And their UK business also taking a hit as well. We'll be talking to Michael Mark, the CEO of Truwords International. Then we talk syntaxes at 6:50 with SAB, talking about the future of excise duties on alcohol. Fatsani Banda, SAB's manager for excise and public policy, joining us for that conversation. Well, last night we told you about that huge settlement for Meta outside of court. Could it affect other social media platforms? And what does it mean for the future use of social media, especially by young people, and how parents can get involved? We'll be talking to tech expert Siphumelele Zondi later on our tech feature. And then in our small business focus, balancing growth and business survival, Jeremy Lang, Managing Director of Business Partners, talking to us about why more South African SMEs are prioritizing steady, sustainable growth over aggressive expansion. In our investment school, we got some of the best brains on this particular topic, a dividend yield versus dividend payout, what the difference means for your investment returns. Grant Nader, Portfolio Manager at Benguela Global Funders, and Gary Boyson, Portfolio Manager and Director at Rand Swiss. All that and more here on The Money Show. For now, let's talk money.
The Money Show
On 702. Let's walk the talk.
On 92.7 or 106 FM and DSTV channel 856.
It's been a busy week for CEOs, whether it's in the private sector or funding institutions like the Industrial Development Corporation, reporting significant financial challenges in the 2026 financial year, recording a loss of approximately 4.6 billion rand, a sharp reversal from profits in the previous year. Now, despite this, the IDC created over 71,000 jobs and achieved 8 out of its 18 key performance indicators. So not a bad story at all. But of course, I'm sure they would like to avoid those losses. And let's get into those numbers then with Mmakgoshi Lekhethe and find out what exactly happened that led to those losses. Mmakgoshi, welcome to The Money Show.
Thank you, Motheo.
So the Industrial Development Corporation, one of those funding institutions that bear the risk. They get into business with other industrialists in our country, especially to try and create jobs. And sometimes it's not only profits, the losses do happen. Can you explain how we got to that 4.6 billion rand?
Yeah, so most of our business partners faced pressures from uncertainty. You'll recall earlier on in the year, the U.S. government hit countries, including South Africa, with U.S. tariff measures, and also the possible erosion of the African Growth and Opportunity Act benefits. We find most of our partners, especially those that are trading with the U.S., and those that rely on imported inputs for their business impacted by this. So if I was to unpack the 4.7 billion, it really is two two key partners, which are a subsidiary of the IDC, Foskor, which found itself in this same environment that I'm talking about, mainly due to the fact that it relies a lot on the production of fertilizer on imported exports that, due to the war in Iran, has either resulted in higher prices for their raw materials, which they could not pass on to their customers. So on the one hand, Foskor has suffered significant losses that, of course, we carry through to the group.
And how much of the stake do you have then in Foskor?
IDC owns 59% of Foskor.
And then there was another bit of a blimp then with a 1.8 billion rand loss for Mozal aluminium smelters. Obviously, smelters not going through a great time. The power prices at double digits at one point. In fact, they've been trying to negotiate with Eskom in order to pay lower prices, but also that steel coming through from China as well, hurting our market. How exactly did they handle the business over the period? And just speak to some of those 1.8 billion rand losses.
Yes, so the balance is made up of Mozal, losses suffered out of Mozal being put on in care and maintenance due to a lack of agreement on a power supply agreement for Mozal. And so as shareholders, the decision was to put Mozal in care and maintenance. So that is what really contributed to and that loss having to be passed on to the IDC balance sheet as well. And yes, we are. IDC is a significant shareholder in Mozal, and we are keen to see it open. So we've been engaged in discussions behind the scenes with Eskom, with the Mozambicans, to really find a solution and find a lasting power agreement that will allow Mozal to come back on stream.
And what's the agreement with your business partners then? If there are hits to be taken like this, do you take the full heat, if one could put it that way, or do you then split the losses?
Well, we split the losses, so the contribution that will come to the IDC, for example, if we're to use Mozal as an example, we own 35% of it. So it will be, so that 1.8 that you see will be the portion that comes to the IDC, the rest goes to the other shareholder.
Revenue was up 20 billion rand, and I believe you reported a bit of a profit then still during this particular period. But looking at your targets, those 18 key performance indicators, you achieved 8 out of 18 of those, which is around 44%, if my math is correct. Are you happy with that particular outcome?
So the outcome is mixed. We could have done better, I must say. But we are happy when you look at our development effectiveness indicators. And these are the jobs that are to be created in the investments that we have made. We're quite pleased with that because we've been able to, just from the funds invested from IDC's balance sheet, been able to create close to 18,000 jobs. The balance of the jobs, of the 71,000 jobs, came from our partnership funds, which for us is a vote of confidence from our partners to co-invest or entrust the IDC with funding into employment creation opportunities. We're also quite pleased with what we've been able to do with the contribution to electricity generation capacity. So energy is quite high on the sectors that have received any funding from the IDC. We've been able to contribute towards 1,000 megawatts in electricity generation capacity. So, I think the results are mixed. Obviously because of the losses, but the losses are understandable from our side, and we could have done more.
The amount of money dispersed over the period, 17 billion rand. On the revenue side, getting the money into the business, were you happy with some of the numbers you took there?
Yes, we have been, and we are actually not surprised because, when you look at the sectors where we have invested, these are sectors that are really performing well. Most of our money, manufacturing, even though it has come under pressure, it's a sector that creates jobs, and it's a sector where our investments are doing quite well, and also in agriculture and agro-processing, we're doing quite well there, and investments in infrastructure. So these are sectors that have paid as well. So the revenue numbers for us are not surprising. And also, by the way, IDC benefits from dividend payments that we get in entities that in the listed entities that we have shareholding in.
Is there an appetite then for new industries like we're seeing with the chip makers elsewhere in the world? Some companies and economies focusing on that, building components, some building the cloud computing hardware in their countries. Are there companies approaching you for that sort of funding in going into the future?
Indeed. I mean, our focus on critical minerals is mainly because of the IDC's deep experience in long-standing strategy of investing in early-stage mining. And so we are quite interested in looking at these sectors of the future because critical minerals, as you know, are very critically important for the battery manufacturing value chain. So we are seeing an interest, and in fact, in some of the projects that we are funding are going to help unlock the green economy opportunities from the critical minerals. So mining being a very strong sector that the IDC understands quite well is a sector that we are looking into, but specifically for sustainability purposes.
As a development finance institution, you hit with a 3.1 billion rand tax bill. Is there a way to decrease that, or is it just comes with the pain of trying to develop these different industries?
It does. Part of it came from Foskor, and part of it is from the IDC. It is the pain of this being a DFI. I must say, though, that we are in engagements with the powers that be, including the SARS and government, to really consider IDC as a tax-exempt DFI, given the role that we play in the economy and in protecting and defending industrial capacity.
All right, that was the IDC CEO Mmakgoshi Lekhethe talking to us about their latest numbers. A mixed bag of results, as she has put them. A 4.6 billion rand loss there, and in terms of those smelters that they do support, but revenue up 15.8 billion rand with operating profit at 384 million.
702 and K-Talk. Motheo is on The Money Show.
If you're heading to the airport, give us a listen, because an unplanned shutdown at Sasol's Natref refinery disrupted fuel supplies to OR Tambo International Airport. Sasol are saying the outage at one of Natref's downstream units affected its ability to meet full supply commitments for certain product grades, including jet fuel. We're now joined by Dr. Guy Leitch, aviation analyst, about this particular story. Guy, do you know just how bad the situation is? Do we have flights that are taxiing and not moving because of this?
Yeah, hi, Motheo, nice to be with you. Look, the situation is not critical at the moment. In fact, as far as I can ascertain, no flights have been cancelled, and I'm not expecting any flights to be cancelled. However, it's balanced on a knife edge. There are critical supply deficiencies, and at this stage, the airlines are working around the problem by tankering fuel, as the phrase goes, which means taking up extra fuel at, for instance, Durban and Cape Town, so they don't have to refuel in Johannesburg. That adds significantly to their costs as well. But for now, the situation is stable. The thing that we need to take from this, though, is that there's been a persistent underinvestment in infrastructure. The reserves at OR Tambo are still sitting at just over 7 days, and that is not sufficient to cater for the 45 days that Natref is expecting the fuel supplies to be disrupted.
And what is the normal threshold for any airport, even if at an international standard, in terms of fuel supply? What is expected of you as a supplier?
Well, it's very much a negotiation between the airlines and the service providers, such as AXA in this particular case, and the fuel suppliers, of course. Given the conflict in the Middle East right now, I would suggest that at least 3 weeks is an absolute minimum. I mean, we see this fuel supply crisis bubbling up every 6 months to a year. It was just 7 months ago that we had the previous crisis in terms of fuel supply. And the reason is because really we're not able to satisfactorily rely on the refineries in the Gulf. Even if the Straits of Hormuz was properly open, it's the refineries in the Gulf that have been damaged in the war. So we're overly dependent on Natref right now. And with Natref having a technical problem as much about 10 days ago, and then this 45-day planned shutdown, it's going to create a real problem for the airlines, but I think they're going to be flexible enough to get around it.
And hopefully that is handled quite quickly to try and make sure that, of course, there is constant movement. OR Tambo, the biggest airport here in South Africa, so you want to make sure that those airliners are in the sky as soon as possible. Then that is Dr. Guy Leitch, aviation analyst, talking to us about that unplanned shutdown at Sasol's Natref refinery that has affected the OR Tambo International Airport.
The Money Show.
The markets.
Let's have a look at the markets now. Nvidia, the big story out of the US, their shares up more than 7%, and really the proof, I guess, for them in the pudding that AI and that AI investment is worth the money. Graham Kerner, Director and Portfolio Manager at Kerner Perspective, joins us for that conversation. Graham, are you also convinced with the AI pitch that Nvidia has put forward?
Motheo, if you stand in the way of that train, you're going to get flattened. So, I mean, just for context, this is a business that's going to probably produce revenue in this financial year almost the equivalent to the South African economy. Next year, I think they're predicting 70% up. The GP margin is going to go down from 75% to 72%. Yeah, it's an absolute money-making machine right now. But I think your question is well posed, and the reality is that it's been weak in the run-up to these results. But really, some people were saying, we can nitpick some of the commentary, but the reality is that thing is absolutely, they've got a money-making machine or printing press in the basement, and they're making full use of it. So I think the reality is that the visibility is pretty good for the next couple of years. And I suppose, a lot of people were not in this one for a long time and paid the price. And now there's a lot of anxiety about when will that revenue and earnings cliff happen. But I think what they were saying yesterday is it's not happening anytime soon. And I listened to a really smart person who said, this is revenue on sales. This is not revenue or supply. This is not revenue on demand. Yeah. Demand is a lot bigger than that. So at least for the next year, you sort of feel, you're reasonably safe there. And the valuations are not ridiculous considering the kind of growth they're going to deliver.
Not much to write about on the JSE, but Assurance, the good story, up 9% today after they reported on earnings.
Yeah, guidance sort of 21 to 26. The headline number is quite a bit lower. And obviously we'll have to wait for the granular detail, but it looks as though SA, P&C, the private personal business is really flying there. Obviously, Ireland is still yet to turn profitable. But maybe one of the examples of a South African company that expanded offshore and didn't get annihilated in the process. So it really does look like a really great result, and the market rewarded it, as you say, up almost 8% today.
That is Graham Kerner from Kerner Perspective giving us the latest in the international and local markets. But as of the JSE, quite flat today, down 7 points, the all share. Industrials up 0.5%. Some weakness for banking stocks that were down 0.5%. Mining shares also coming in lower. the hardest hit companies today. Harmony down 4.9%. Truers, who we're chatting to a bit later, down 4%. Discovery down 2%. Capitec down 1.5%, with Standard Bank down 1%. Some great wins for our insurance, up 9%. Karoo, the owners of Cartrack, also up more than 4%, with Pick and Pay and Tungela enjoying some gains.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
6:43 on The Money Show. Let's get into the retail sector now in terms of numbers and results. And we focus on Truers, which released its results for the year ending in June 2026. The retailer reporting a tough set of results for its 2026 financial year, with a decrease in sales. And also the numbers are coming at a far lower base than the full year for 2022 levels, while the retailer share price fell by 4% on Thursday. These results showing that the retailer's retail sales went down by 0.9% to 21.8 billion rand. We are now joined by Emmanuel Cristado, the CEO, the Deputy CEO and CFO of Truers. Welcome to The Money Show.
Thank you, Motheo, and welcome to your listeners too.
Emmanuel, a tough time for most sectors in South Africa, given just the high cost of living and the fact that we as consumers are holding back some of our spending. Just explain for us in a broader sense how the year has been for Truers.
Look, it's been a really challenging year for Truers, or for the Truers Group. You know, we've had challenging times in both in terms of the environment in South Africa and in the UK. The macros haven't been ideal in both territories in which we operate. So our sales declined by 0.9% and our headline earnings declined by 2.6%. But within that context, I think there were a lot of positives. So we managed to protect our margin. We remained cash generative. You know, we generated, our cash conversion rate was improved to 97% from 90% last year. Office grew in sterling, that grew by 4.9% in a really tough climate. But of course, when you do the conversion back to rands, with the rand being stronger, some of that falls away. And then Truers Africa improved our performance. So the first half, we were down by 3.6%. That was announced in our half year. And in the second half, we were pretty much flat. So that shows nice improvement. We continued to invest for growth, and we continue to grow our online. Truers online is growing in double digits. It's now over 8% of our turnover. And from a group perspective, we grew online to 21% from 20%. So although very tough, and the consumers are facing some headwinds, and we of course think we would have liked to have a better result, but there are some really good positives coming out of this.
Look, during tough times, things like credit and issuing of credit become quite squeezed, right? As more consumers find it hard to pay back the money that they've borrowed on the accounts that they've used, right? The segment highly credit dependent for consumers. So in terms of your active accounts and your consumers over the period, do you still have those quality consumers that are readily available to pay back on some of the credit they buy clothes on?
Yes. Look, credit it goes up and down. So you go through tough times and you go through good times, and we've got an abundance of scorecards. We manage our book with over 50 scorecards that naturally pull in the credit that we give, or let it go slightly when times are tougher or better. So at the moment, it is a bit tougher. So you'll see we've raised our provision slightly. But Motheo, it never falls off a cliff. So we have a 2.9 million active customers. Our overdue percentage is the same as what it was last year. And although we're seeing slightly tougher times, we trade out of it. It's just one of these things that we've done many, many times before. You know, credit has been in Truers for over 50 years now, and we've got great expertise in that. And we use credit as a lever to sell product. So when you're selling product that is aspirational but higher priced than some of your competitors, credit becomes an absolutely key instrument to sell product to consumers. So there is there is some challenging times going ahead on the collection side, but our book is actually in good shape, so we raise the provisions a bit. When times get a little better, the provision releases, and it's a cycle that we followed many times before.
A lot of the retailers reporting on results over this past year, whether it's food retailers, clothing retailers, have also relied on their online businesses to save them and to save the bottom line. Is this the same for Truworths as well? Are you seeing a lot of action on the online side of things instead of the brick and mortar stores?
That's an interesting question, because we've never constrained online in Truworths or in Office in the UK. And Office has stabilized at about 44% of their sales being online. They did take a jump just during COVID and just after COVID, and it stabilized at about that. Truworths continues to grow in double digits. So we grew online by over 20% this year. It's now about 8% of our contribution, but we don't constrain it. So it's what the consumer wants to do. We actually find that the bulk of our products that are ordered online, particularly in South Africa, are picked up in our stores. And so the bricks and mortar complements online, and they work very well. They work well together. And so we haven't seen mass cannibalization at all from the bricks and mortar stores. Yeah. In fact, we think they complement them.
Over the past financial years, we've seen a great expansion from food retailers like ShopRite. I'm talking brick and mortar stores. Boxer doing the same, opening new stores. Is the story the same for Truworths? You're going to be opening new stores, or given the numbers coming in lower, you're going to hold and wait?
Now, in Truworths, to grow real estate is quite difficult. In fact, this upcoming year, for the first time, we will grow it a little. We've got around about 800 stores, I think, so we're everywhere. So when a mall opens in the country, we typically go there, and we in the center of the fashion court. So the real estate growth in South Africa is fairly limiting, although we are growing by a couple of % in the upcoming year. In the UK, it's the opposite. So we grew real estate by 18%, and on an average basis by 8% in the year. And there is more opportunity to grow in this next year that's coming. So we'll grow it in double-digit numbers again this next year. So in the UK, quite a bit of opportunity for additional stores and store growth. And in South Africa, it's limited, but we try to be where we want to be.
Are you concerned at all with the fact that consumers now have a broader, say, brands to shop from on online basis, right? When you look at the likes of Shein, the fast fashion, everybody is getting their stuff delivered to their door. Are you at all threatened by that part of the business just squeezing you for numbers a little bit?
Yeah, I think Shein and Temu and other online players are certainly competitors. I wouldn't put them above the likes of some of our other big competitors that we have, particularly in South Africa. But it's all part of the mix, and one has to deal with it and face it head on. And you often learn from the likes of the Sheins and the Temus on how to do things that are better. So they do take part of the basket. And the basket isn't growing as much as we would like it to grow with poor GDP growth.
Yeah.
And so what we do, we're not fixated by them. We of course look at them and we look and see what they do, and we learn as much as we can from them, but we focus on what we can control. We put our heads down and do what we can.
Emmanuel Cristado, the Truworths Joint Deputy CEO and CFO, telling us about their numbers. Thank you so much for your time, sir. Their sales are down 0.9% to 21.8 billion rand, with the sale of merchandise also growing very marginally at 0.1% to 21.3 billion rand.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud to support Genza Energy's investment in the infrastructure powering West Africa's growth.
Welcome back to The Money Show. Well, you might be pouring a stiff drink after a very long Thursday. On your way to a Pooza Thursday meetup with your friends, you might want to listen to this one because we're talking about the alcohol and excise duties that could change. Talking to SAB, one of the largest brewers here in South Africa. The National Treasury has called for public comments on the future of alcohol excise policy frameworks in South Africa. The consultation aiming to gather detailed written comments and proposals to assist the government in developing an appropriate excise policy framework to reduce the harmful use of alcohol. We now joined by Fatsani Banda, the Excise Tax and Policy Manager at South African Breweries. Fatsani, welcome to The Money Show.
Hi, thanks, Motheo, and thanks to your viewers for listening in.
Never something we want to hear when we listen to the budget here in South Africa around sin taxes, but we buy our brewery, our brews anyway, our favorite drinks, our favorite poisons. What is the lead policy here from National Treasury in terms of changing the future of excise duties?
Well, it's been a long time coming, Motheo, and the last time the excise policy was reviewed was 10 years ago. The industry has been participating in the budgetary process in general, calling for excise taxes that are increased in line with inflation. Treasury has, over the last 12 years, only on 3 instances, increased excise taxes in line with inflation. So to call for more tax predictability and tax certainty, allowing us, of course, to business plan and invest, we've asked for a concerted effort in this regard. We've been met with policy proposals that are not in line with CPI, and we've called for National Treasury to think about factors such as the growth of the illicit alcohol market in thinking about above inflation excise increases being entrenched in the excise policy. We continue to have discussions on that in particular, as well as other proposals, in particular 20% increase in the standard rate of beer, given that the excise plays a big part in the policy and price gap between illicit alcohol and legal alcohol. And as SAB, we've drawn attention to this, saying that the policy discussion and the policy drafting cannot not take into consideration the growth of the illicit alcohol market.
National Treasury wants to permanently link annual alcohol excise taxes increases to inflation. Does that mean when inflation drops, the price of alcohol will also do the same?
Well, there are many international benchmarks that have, many countries rather, that have excise increases in line with inflation. In South Africa, we've never seen a decline. When inflation goes down, and there have been instances in that over the last 12 years, the excise increase does not go down. But in countries such as Canada and the UK, there's been more of a rationalized process, and that should have been the case in South Africa. Unfortunately, National Treasury has not put on the table excise increases in line with inflation. It has put on the table excise increases to a limit of up to 10%. So that would amount to a 10% annual increase in excise taxes. And we say for a business, for an industry that hasn't grown above 2% over the last 6 years, that would lead to the deterioration of the industry sustainability, affecting our 250,000 job value chain and in general our contribution to GDP. And we think that would exacerbate the already existing growth of illicit alcohol, currently amounting at 18%. And we think that needs to be taken into consideration in the drafting of the policy.
Is it worth making the argument as South African breweries and I guess other players in the industry to say we already pay corporate taxes? The sin taxes, if you will, also contribute to the economy. So pushing the price any further will lead to consumers having other options like we've seen in South Africa in the illicit industry. In fact, the Beer Association of South Africa has warned that proposed changes to the country's alcohol excise policy could increase taxes on most beers by at least 20% and leaving those who don't have the money to buy their favorite drinks to go to shadow alleys to get some of their beverages.
Absolutely agree with you, Motheo. I think what SAB has said over the years is that we agree with paying our fair share of the taxes contributing to the fiscus by means of corporate income taxes, as you mentioned, excise taxes, and the likes. And I think that's an important caveat to say, are we continuing to allow the beer industry and SAB as a player to continue to comply with the law and pay its fair share, knowing that in the macroeconomic environment, consumers are cash-strapped, and to ask them to pay a 20% increase or to bear the burden of a 20% increase in the excise tax is maybe a bit punitive or excessive to ensure that the industry is sustainable and is paying its fair share of the tax. And all those factors, I think, SAB and the beer industry in general has put on the table. The illicit alcohol market is growing. The price gap between illegal and illicit alcohol is around 37%, and the macroeconomic conditions aren't that great for the purchasing power of consumers in general. Is that being taken into consideration? We think not, but we continue to have the conversation to say every economic impact or scenario needs to take into consideration two factors. Firstly, illicit alcohol, and secondly, the current macroeconomic conditions, and not in isolation of the two, in order to have a long-term policy that is sustainable and has changes that improve the system and not deteriorate for the beer industry.
And I'm hoping we'll be toasting to an agreement between Treasury and industry very soon. Afazani Panda, SAB's manager for excise and public policy. SAB saying an inflation-linked framework would provide a balanced approach by maintaining the real value of excise revenue while avoiding excessive tax escalation.
And now, The Money Show with Motheo Khoaripe
on 702. Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud to support Genza Energy's investment in the infrastructure powering West Africa's growth. If you've just joined us, we've covered the Industrial Development Corporation's results. They booked a 4.6 billion rand loss for the past financial year, but were able to create 71,000 jobs through their partnerships and financial funding for different companies in industries, and achieved an 8 out of 18 in the key performance indicators, which are found to be poor at around 44%. The company's revenue for the year was at 20.6 billion rand. Then around the issues on Sasol and Natref. Fuel supply at South African airports has been a key issue for AXA, and it continues. The company, Sasol, saying they've had to close down their Natref refinery, disrupting fuel supplies to OR Tambo International Airport. Sasol saying the outage at one of Natref's downstream units affected its ability to meet full supply commitments for certain product grades, including jet fuel. It doesn't mean flights aren't taking off at the OR Tambo. The flights are taking off. There are some tanker alternatives in terms of fuel supply, but in terms of the requirement to have at least 3-week fuel supply, Sasol not quite there, and the closing of this Natref refinery also ruffling the feathers there at the airports. But for now, let's talk tech.
The Money Show, Tech Thursday.
Major week for tech. We've just had NVIDIA's results proving that artificial intelligence is the way to go, and firstly in way of investment, but also trying to make an investment case in terms of capital investments for their revenue going into the future, promising a big jump in revenues by 2028. So they had a good year of it, but Meta not having a good year of it, of course, after that particular court case in the US that found them settling out of court at close to $8 billion. But that's not the major issue, that particular settlement. The major issue is what happens next. Does it change the way we use social media? We are joined by Phumelele Zondi, a tech expert here on The Money Shows. Phumelele, that particular settlement also, setting a precedent for other social media platforms. And I'm sure they also are trying to gear up their budgets for whatever court case may come.
Hello, Motheo. And yes. So, in fact, that's what Meta has also said, that because the case was against Meta, and it's Meta that because they're the ones who the settlement, and therefore then made a call to say, but we're not alone. They said there are other social media platforms that operate pretty much in the same way. They largely highlighted YouTube. They also highlighted TikTok to say they also are in the space that they're in. So what about them? Why is it just Meta? And they've said that as much as they have to pay the amount that they have settled on, they have said that they want to hold back 30% of that amount unless other companies are also forced to do the same. Those companies that are in the space that they're in.
I want to talk about the child safety measures that come off directly off this case, amongst them being the 2-hour limit as a default requirement under this particular settlement rather than an absolute ban or no longer using social media. So a bit of tight controls around user safety.
So these will be mechanisms and features that will be introduced in Meta products. So whether you're using Facebook, WhatsApp, or Instagram, you're going to have this feature, and also it gives parents some sort of control if the person is under 18. We do know that in the past there've been conversations and sometimes there've been features for under 13s, but now it's been bumped up to under 18-year-olds. But again, it still relies on. Without someone monitoring this feature, no one really is going to know whether they're abiding by this or not. It's a 2-hour daily limit. There's a nighttime blackout, for example, between sometime in the night until 6 a.m. Kids are not to be.
Spumelela, I'd like to get you on a better line, man. We can't do Tech Thursday on such a shaky line. So let's try get you on a better line, talking there about that settlement that came through for Meta. But moving forward, what happens next in terms of uses for social media? Parents, of course, having a bigger role to play with that settlement, stating that there could be mechanisms put in place to make sure that parents control how much time their kids spend on social media. Meta willing to automatically activate night mode for teenage accounts, blocking access between midnight and 6 a.m. The settlement builds on an existing feature that muted notifications for teenagers at night. Under the new arrangement, the restriction goes further by limiting access to the platforms during those hours. The agreement also introducing restrictions on notifications during school hours, aimed at reducing interruptions between 8 a.m. and 3 p.m. on school days. I don't imagine that teenagers would be too happy about being restricted on social media, and they always find a way, don't they? But Spumelela, I want us to move on then to the robo-taxi wars that are currently happening in Europe. Europe launching driverless taxi services. The battle for robo-taxi dominance happening in Europe. Alphabet's robo-taxi unit way more stoked to get into that particular field. Germany giving them a license to operate. How's it looking so far in terms of investment and just user take-up for people just jumping into a taxi without a driver?
It's been happening quite well, Motheo, especially in the United States of America, where it's been tested largely in Austin, in Texas. And we did hear that Tesla does want to expand to the rest of Texas before the end of the year, and then later to the rest of the United States. Now, jumping over to Europe, it's quite interesting that it's Waymo that's been given the red light, because we have been hearing the automobile sector in Germany saying that it's taken quite a knock because of foreign companies. But if foreign companies are more innovative than German companies, because it's American companies that have and Chinese companies that have been working on this autonomous vehicle system, and that's why Waymo has been given the red light, because to start operating in Germany.
And how does the AI used in autonomous taxis work?
So it basically works with a lot of sensors, cameras, and light detection and ranging, which then basically figures out what's happening around the vehicle in terms of the planning and decision making, where there are onboard computers that run on artificial intelligence. and they then figure out what's in the vicinity, what's in the space, and then they make those decisions based on whatever muscle that the vehicle has. And it's worked actually quite interestingly, according to research that's been done in New York, better than human taxi operators. These sensors and this technology that exists, and the light detection and ranging technology that exists in these vehicles, because they do have a lower accident rate than when these taxis are operated by humans.
Wonder how that will affect insurance. But I want to know, when are these taxis being launched in Europe firstly, and how will the service work?
So it seems like they're going to be launched this year in Germany itself. Basically, it works like any other service in terms of because it's been tested in other parts of the world. Think about China, think about the US. You have a pick when you're booking a vehicle.
So like an e-hailing service.
Like an e-hailing service. You have a pick on whether you are booking one that's operated by a human or one that's not operated by a human. And some people might say, well, maybe there actually is an advantage in terms of safety, especially in this country where we've heard of safety issues when they're operated by humans. And here, it comes without having to deal with a conversation, a human who might be or might not be trustworthy.
Are there proper legal frameworks in place? And I say that because a lot of companies launch high-tech things and fix them later as soon as they have a user experience.
So yes, in Europe, they actually have been amending their legislation that looks at autonomous vehicles and whether they can be operated or not. There's the Autonomous Driving Act of 2021 in Germany, which was an amendment of the Road Traffic Act, which was to create this amendment for these cars to start operating in Germany. So yes, they have made provisions, and they made provisions, it seems like, in Germany specifically, as recently as about 5 or so years ago, even before they thought that they would be launching them on the road. So they did preempt that one day to be happening.
That was Phumelela Zondi on Tech Thursday, sharing some of the big stories that happened this week when it comes to tech.
The Money Show, Small Business Focus.
Small Business Focus is brought to you by Capitec. Start up or scale up with Capitec, the business bank for everyone. Let's get into the Small Business Focus today, talking to Jeremy Lang, Managing Director of Business Partners, and why South African SMEs are prioritizing steady, sustainable growth over aggressive expansion. Jeremy, welcome to the Money Show.
Good evening, and also to your listeners.
Slow and steady, that's how it's going at the moment, and that's how to win the race for small businesses in South Africa. Is this a common trend that you're also picking up in terms of that organic growth as slow as it takes, instead of trying to expand too quickly?
No surprises at all. I think when times are a bit more uncertain, more volatile, more unpredictable, businesses generally tend to be a bit more cautious. But I would argue, in general, whether good or bad times, sustainable growth in smaller increments is a more stable way to grow, a more sustainable way to grow, rather than big shocks in growth or very rapid growth.
Now, we're often told in business that you need to go for profits, you need to go for revenue. How do you balance that, the slowly growing as a business, but also making sure you still have enough to survive?
Yes, it's about managing the risks, because when you are trading very rapidly or growing very quickly, you introduce a lot of business risk into the business, like overtrading, liquidity risk. I mean, you need to fund growing inventory levels, growing debtors books. When you're growing very quickly with 1 or 2 clients, it introduces client concentration risk. If those clients don't pay you, or you lose the business, suddenly you've increased your overhead base, and you've lost the client. Also, is your business ready for the growth? Internal controls, process risk. Do you have good well-documented quality management systems? And one doesn't often think of this one, but the impact on staff. It's clear that businesses that grow very rapidly puts a lot of pressure and stress on the existing employee base. And when you start to recruit many new staff, you run the risk also of potentially shifting the culture that you've worked so hard to develop in the business.
But some businesses are a victim of their own success, right? You start something and it really answers a need in the market, and a lot of people then, rush in to try and get service from your business. How do you manage saying no to incoming clients when you don't have a capacity?
Yeah, I think it's about how we manage it. So if you are aware that the demands for your products or services are growing exponentially, it's really important to put measures in place. One is around controls, have a very specific intervention to make sure that as your business grows, your controls, processes, and systems are well established. And then secondly is cash flow planning, and get that liquidity facilities in place well in advance, because no funder wants to help or is very reluctant to help a business that's already finding themselves in cash flow difficulty. So I'm not saying never, but if you do want to take on that challenge and you're willing to accept those levels of risk, just make sure that the controls are in place. It's easy to remember one client that owes you is a lot more difficult to remember 50 clients owing you funding. So the processes and controls should work for you rather than you trying to remember everything yourself as a business owner. And secondly, make sure that the cash flow facilities to fund that growth is in place prior to actually taking on that growth.
It's such a fine balance, because what would be the stress test of knowing that, okay, we've had a 5-man company and, as the 5 of us, we've been able to handle the business that we've been getting, but it seems with more customers walking in, it might be time to perhaps expand on the business in terms of workforce, but also increasing infrastructure around our system. What would be the stress test to know when the next step of growth happens?
Yes, it's about understanding the capacity of your business, both on the operational side, so your ability to produce goods and services with the current infrastructure in place and the plans to expand that. So it's really about how the people, the systems and the processes come together, supported by the liquidity, of course. And then what business owners sometimes forget is that while the operational capacity is increasing, you're acquiring more stock, you're acquiring more machinery to produce more. It's really important to also look at growing and maturing the support services that support that operational activity. Let me give you a very simple example. If you are suddenly doubling the workforce, you also have to ensure the right human resource skill and capacity is in place to grow with that. So it's not just about operational capacity planning, it's also the support division around the operations that also need to grow and mature, and also ensure that the capacity in the support services is there to support the growing operational activity.
We've had that dangerous buzzword, right? Scaling. Businesses need to scale. You're going to the next frontier. And sometimes you scaling as a business is not entirely your decision. Somebody walks into your door. They're a bigger player. They would like to swallow you into their own operation and make sure that you have more branches. They sell you dreams about being a bigger business. How tough is it then to say no when you know somebody has the capital to perhaps have you become a larger operator?
Yeah, sometimes you have to consider the risk, and sometimes you have to say no, because is it worth the risk of putting the business at stake for the scale, or do you manage it in other ways, rather trying to grow it organically or grow it in more incremental steps? Because growth actually consumes cash in most cases before it starts to generate it, and that's what people often forget. So it's really important that that process is well controlled. When an investor comes in, as you've just described, that brings other dynamics. What does that investor want out of the business? How much control do you lose in the process? It's really important to also choose the growth partner, whether it's a debt funder. Debt funders behave differently to equity funders. So before you go on that growth path, it's really important to understand what kind of partner do I want, what kind of involvement do I want by my partner, and what kind of value do they bring to the table. So all of these must be well understood before you just embark on this relationship with a partner.
Any business owner listening to this, small or medium, will tell you, look, I can't wait for my business to grow because I'm the guy who's doing sales, I'm doing the books, I'm doing operations, I'm doing finance, I'm doing the deliveries. I'm literally the one-man business. So I can't wait for it to grow so I can hire more people and delegate more responsibilities. So how do you make sure that even with a startup or something you've started yourself, you're ready to have people come in and help you out with your business?
Yes, I mean, I've experienced both. On the one hand, as you've just described, on the other hand, sometimes business owners find it difficult to let go and trust staff to carry on with what they've built. Yes, indeed. So it's really important that you build trusted people, management level around you, that can take off that burden, because you as a business owner, your responsibility is actually on ensuring that the business is stable, but also your business is the work of tomorrow, the vision, the growth strategy, the planning, taking care of all the big risks and making sure that they are well mitigated. So, but there comes a time where you have to pass on that level of activity, function, tasks to a management layer or one or two additional people that you really trust, that is experienced, that knows what they're doing, and that is competent in those roles.
There's also that growth that's quite misleading as we close off this particular topic, right? A business performance that's quite good, but the revenue and profits don't speak to that. And sometimes you feel that, this is a strong business until you realize that you've been funding it using credit and extending all sorts of finances to make it keep going.
Yes, indeed. I mean, the most misleading or very blunt measure is actually revenue. One needs to look at margins, one needs to look at costs, overheads, and how much the capital costs to support that level of activity. So debt comes at a cost, equity comes at a cost, and although the color of money and the color of notes are the same, the structures in terms of the capital that you raise and the financial instruments you use are very, very different. It's really important to read the fine print, understand the effective cost of the capital, including all fees, charges, interest rates, etc., and that the nature of the funding, is, even in terms of tenure, long-term, short-term, is the appropriate kind of funding and structure that is required for the growth need.
All right, that was Jeremy Lang, Managing Director of Business Partners, talking to us about the importance of noticing when your business should grow and how more South African businesses are actually prioritizing steady, sustainable growth over aggressive expansion, which can quickly kill a business. That is, of course, in our business feature today, the Small Business Focus. Jeremy Lang taking us through our paces there.
The Money Show.
Investment School.
And we've got some of the best brains in the game when it comes to investments. Grant Nader, a portfolio manager at Benguela Global Fund Managers, joins us on Zoom, while Gary Boyson, portfolio manager and director at Rand Swiss, joins us in studio for our investment school. We're going to be looking at the rewards that shareholders get as they put their money in portfolios and they put more money in trying to make more money in their lives. Dividend yields as well as dividend payouts, explaining those two concepts and how exactly they're linked to your investments. Gentlemen, welcome to the Money Show.
Good evening. Thank you. How you doing, Gary?
All right, let's get to it. Everyone wants to make a bit of money when they invest money, and more investors will want to hear the word payouts. They want to hear about dividends, especially when companies give out results. Gary, let's start with you. As investors, we listen for those words, right? The dividends, when a company gives out results, and because we want to know just how much we're getting from the money we've put in.
It's not all about dividends, though. So I think it's maybe a misconception that dividends are maybe investors are overly focused on dividends these days because there's many ways of returning value to shareholders. So of course, I suppose the traditional mechanism is once you've made a profit, you allocate a portion of that via, let's say, a dividend payout ratio to your investors, and that's the reward for being an investor. But these days, specifically looking at S&P 500 stocks, a lot of them are now, pursuing share buybacks as a way of returning capital to shareholders instead. And I think you can't discount the returns, the capital gains that we've seen in securities that, have viable, investment options that can buy other businesses that yield better results for investors and even investing in their own business if they have projects that will continue to create value. And we see it specifically in the US tech sector that a lot of the money the company makes is reinvested, and investors might not be receiving a high dividend yield, but they're receiving incredible share price performance, and you can always trim off a couple of securities to release the return that you're looking for.
And for that young person that's probably way past their bedtime at the moment who's listening, who wants to know what a dividend is, what would that be?
A dividend. The dividend is as simple as it's essentially the allocation of the cash flow that comes to you as an investor. So, if you buy 100 Rand security and the company declares a 5 Rand dividend, your dividend yield is 5%, and essentially you're going to get 5 Rand paid into your account. Of course, you're going to have to pay the dividend. Well, you don't pay it; it's taxed at source, but you pay a 20% dividend withholding tax. But you'll receive the 4 Rand into your account. So that's cash in your account, and it's up to you now to spend it, deploy it, reinvest it, make the decisions with the cash as you would, because you're no longer relying on the company management team to make those decisions.
And Grant, how can we use a dividend yield or dividend payout as a way to assess our investments in different companies?
That's a really interesting one, because one has to be a little bit careful. Sometimes a higher dividend yield looks optically very attractive, but it could be a result of a company that share price has fallen a lot, and then those dividend yields may not be reliable. So you need to ensure that if there's a high yield, that you're actually going to get that payment in future. Otherwise, it's a bit of a trap, a value trap, if you like. But a company that pays a reasonably good dividend and has a track record of growing that dividend over time, that makes a good investment, because that adds a layer of return to your capital growth, and you get a very attractive total return if you can find a sort of consistent compounder. And of course, I would like to just add that if you're looking at something, are you a dividend investor, is part of your thinking needs to be, what am I investing for? What's my time horizon? Because if you're just investing for income in the short term, you can find safer ways to get it. But if you're thinking longer term, then it's a different equation. So every investor has a different need for different type of stocks in their portfolio. And as Gary said, a growth stock is probably something that the younger generation should be leaning more toward. But as you're getting closer to retiring, or as you're getting less less keen on risk as you get older, dividend is a nice diversifier, stabilizer in the portfolio, and can just balance out some of the volatility of share prices itself.
And I guess that's where the discipline comes in, right? A dividend payout is not really a payday for you as a shareholder. You could, reinvest that money and not even touch it.
Yeah, absolutely. And some of the best strategies are to continuously to compound, reinvest that and put it back. If you don't need the money, rather I suggest you do reinvest it, especially if it's a good business. And you find, like, in that way, over time, you can build up an increasing stake in a good company, and you're accumulating a rolled up yield that looks very attractive, down the line. So it's nice to receive the divvy, but if you don't need it, don't let it sit there idle in cash.
We have cash divvies and stock divvies, and just explain to us the importance of looking at other ways of getting value, like you were saying earlier on, things that you can look at to gain value from the companies that you invested in.
Yeah, so I think, when you're trying to assess a company, Grant makes a great point. It really comes down to the strength of the underlying company. So if you just screen on dividend yield, you're going to find, I think if you screened JSE at the moment, you'll probably find Italtal as one of the highest dividend yielding companies out there. And there's nothing wrong. Italtal has a great balance sheet. They're paying a special dividend at the moment, but that's going to be a trailing 12-month dividend. So that's saying historically they've declared their special dividend, they've declared an interim dividend. There's a lot of cash going to come out of the security. But typically, if all things being equal, if you had a stock at 100 Rand and it's going to pay a 5 Rand dividend and there's no movement, there's no other influences affecting that share price, the calculation, that share price should drop exactly by the dividend on the ex-dividend date. So as soon as the dividend comes out of the stock, you should see the share price re-rate anyway. But to Grant's point, you need to look at the underlying operational businesses and whether they're going to pay you a dividend. It's more important to know what is this business going to do in future, and is that dividend secure? Is this a company that the dividend yield is just really high because the stock price has collapsed, or is this a company that can consistently pay these dividends? And I think that's really critical, because it's all well and good to say, like, go and buy an exciting company. Don't ignore the dividend yield entirely and just buy a great company, because a great company, its share price will appreciate as the earnings increase. But I think it's also important to remember, dividends, those payouts add up quickly. And I think if you go back on S&P 500, I think it's to 1926, and you look at the total return. So you look at the capital appreciation, so how much your share prices have gone up, and you look at and then you add back the dividend yield to get that total return. I think it's around a third of the value that's been created is from dividend payouts. So I think the S&P 500 dividend yield is, it's 1 and a bit % at the moment, but over time, 1 and a bit % per year adds up to a massive amount.
And Grant, how should we let those, the dividend yields and the payouts determine our investment strategy? Are we, scouring for businesses that give out really, really high payouts, and that's how we're going to have or build an investment portfolio? Or is it a deeper way of looking at the structure of the business and where it's going?
So first of all, I think if you're looking to build a dividend income portfolio that's going to pay you a healthy return every year in income, one of the things you need to think about is it a cyclical business, or is it a sort of a reliably stable business? So you get what's called dividend aristocrats, where they pay an increased dividend consistently over more than 10 or 20 years, depending on how you want to define it. Think of your British American Tobacco, your telcos, maybe the banks. That higher dividend yield is reliable, and it tends to grow over time. Whereas, and even your staples, your food producers and your food retailers. Whereas something like a miner, they go through stages where their dividend yield is incredibly high. Kumba has paid 10, 12, 14% dividend yields at times, but a year later, the dividend yield could effectively be 3 or 4% or nothing, because the commodity cycle could have turned. So you need to understand, if you're investing for dividend, you need to look into the business itself. What is the sustainability of that dividend? And does this company have enough cash or enough growth runway in front of it to keep investing and keep growing that dividend and pay that back to you? And is it reliable? So it really depends on what your objective is. So I would build dividend return portfolios around stable companies, and then perhaps in the sort of growthier stuff, you're looking for higher growth, less payout. You want them to be reinvesting so that they can grow the business even faster. But those are the other kinds of businesses, and it's important to just figure out which one you're looking for, and go that route. So the other risk is that a company that pays out everything they earn in dividends tells you that they have nothing left to invest in. There's no opportunities for growth. So you can't really expect a higher payout next year. You can just expect more or less the same, and the same the year after that and the year after that. And if that's the case, if they don't increase dividends over time, you may as well put your money in the bank or in a bond, and it's a much safer way to earn a return. So there's a lot of those kind of things you need to think about.
And Gary, how important is it to have that balance, right? Companies with high growth potential may sometimes retain their earnings, resulting in low dividend payouts, while far mature companies will often have higher payouts. So having that balance in your portfolio.
Yeah, so I think Grant kind of hit the nail on the head there when it says that it depends on what you as an investor are looking for. And different investors have very different requirements. So, if you're looking specifically because you're a retiree and you actually need to service monthly income because you no longer have a job, and you potentially, like, you need this cash flow to pay pay your electricity and, buy food, etc., then of course you're looking for a lot more stable dividend pay. You can't go and, when a commodity cycle is up and, the gold miners are producing enormous profits and paying it all out to shareholders, those would be the wrong kind of companies to put in your portfolio, because you need that stability. If you suddenly have the gold price collapsing, Anglo Gold, Goldfields, Harmony, they're not going to be paying those dividends anymore. And when you go into, let's say, a 2008 financial crisis, a lot of stocks cancel their dividends. They're nervous about paying out cash because they're uncertain of the future. So even if it's a great business, and even if it's riding that kind of macroeconomic event, they might still stop paying dividends, and suddenly you're sitting in a position where you now no longer can afford petrol. So yes, you've got to be very cautious of it. I think, to Grant's point around, there are other asset classes as well. You can go and buy a bond. You can look at a property REIT, which, it's still kind of a dividend. It's called a distribution, where they'll pay out essentially the rental that they're getting off the property. They're very different types of investments, but these investments are also taxed in different ways. So you've got to understand at what point of your life. What is your personal tax rate? Sometimes a dividend portfolio can be a lot more attractive for a high income earner. If you're sitting facing a marginal tax rate of 45%, and this cash flow that you require that's coming out in the form of dividend, as I said, dividend withholding tax is 20%. If you go and stick that in a bond, you're going to be paying, that comes out as income. So if you're a marginal taxpayer, anything you're generating there, you're paying 45%. So you've got to then adjust it for your after-tax return as well.
So as exciting as it is, Gary, if you get paid out, it could push you into a higher tax bracket, and you could...
Not with dividends.
Okay.
So because the dividends are taxed at source, and it's a 20% flat dividend withholding tax. But if you're going and buying, like bonds, direct an income portfolio, absolutely. Like depending on the size of the income component of a balanced portfolio, that 100% that could push you into a higher tax bracket. You might end up paying more tax than you would have potentially needed to if you had structured your portfolio correctly.
And how do you structure then that portfolio, Grant? There's also the option of mutual funds as well, and other vehicles that Gary has pointed to in terms of them paying out dividends. How do you structure your own portfolio in a way that, firstly you're protected tax-wise, but also you're not too focused or, too heavily focused on the payout?
It's a good question. I think it's important to figure out what your goals and objectives are up front, and what's your timeline. But then simplifying it, you want a bit of diversity. Each pocket in your portfolio serves a different purpose in different environments. Different kinds of companies do differently. Your high dividend, reliable dividend payer is a much more stable company, but it's not going to shoot the lights out the way some of the other companies can if you get your in the right times. So, and investing in a mutual fund gives you the tax benefit. It's not taxed until you crystallize that. If you keep the money in there and you reinvest it, you're not getting taxed in your own personal hands. I guess there's a few ways to look at it. From a personal tax point of view, you don't want to be taking money out. And as Gary said, dividends are actually more tax efficient. But if you're getting paid in share buybacks, you don't get taxed at all. That just, the company buys those shares back and you hold on to your shares. You're getting paid via an increased shareholding in the business. So those are good ways to structure your kind of tax efficient for shareholders. There's a few different ways to think about it. It's difficult to give tax advice without individual circumstances are all different.
They're so different
from a tax point of view. Yeah.
You are in our investment school. We're talking dividend yields and dividend payouts with Grant Nader, portfolio manager at Benguela Global Fund Managers, and Gary Boyson, portfolio manager and director at Rand Swiss. Join us after this.
The Money Show with Stephen Grotes is brought to you by Absa CIB. Proud to support Genza Energy's investment in the infrastructure powering West Africa's growth.
The Money Show.
Investment School.
Investment School tonight talking dividend yield and dividend payouts with Grant Nader, portfolio manager at Benguela Global Fund Managers, Gary Boyson, portfolio manager and director at Rand Swiss. I want to talk about building a portfolio that maximizes investor returns. Obviously, it's a very, very broad question, but if you could, structure one for us, Gary, what would it look like?
We just maximizing returns.
Yeah.
Just returns.
Just returns.
This is not risk-adjusted returns.
Grant will get into that.
So I think that it's something that I think a lot of investors focus on. A lot of retail clients look at. They look at one aspect of the investing, which is the return profile, the performance. They just want performance, but they don't look at the risk they're adopting to generate that performance. So if my goal was just to generate high performance, but I can take as much risk as I want.
I know you love risk.
I don't necessarily. I'm getting old, but I'm definitely becoming more conservative. But at the moment, our most aggressive portfolio is an AI thematic portfolio. So it's investing heavily in what is an aggressively expanding segment of the market, and the returns are phenomenal. I think we've tripled money in that portfolio over 3 years, and that's without any gearing. If you really want to chase performance, though, you could gear that up as well. So you could add a little bit of leverage, and you could probably have done, in that portfolio, you probably could have done 6-10 times your money in the last 3 years. The challenge, though, is that if we do see AI slowing down, if we see the spending on data centers pulling back, the volatility is going to be very high. And if you suddenly have added gearing to that, you very quickly run out of money. and it's very easy to blow up an account if you're adding leverage. If you're not adding leverage, even then, I look at the volatility. We'll have months where in this little pullback that we saw during earnings season, there was a couple of wobbles around results. I think it was June. The portfolio was down about 15% in dollars. We recovered immediately after that, like all the way back up to highs. But it's serious volatility because you're chasing performance, for a very high risk level. If I was looking at risk adjusted performance, then you construct the portfolio in a very different way. They say concentrate to create, diversify to protect. So if you're aiming just for performance, you concentrate down, you go and pick a couple of really good stocks that you believe in, and you adopt the risk, and then you'll get hopefully the commensurate return. But if you're trying to do this longer term, like I would say, you've got to look at the risks, you've got to look at your volatility, you've got to diversify across sectors, you've got to look at the margin of safety that a security has. You've got to be very cognizant of valuation. There's all other factors that come into making sure that the type of investing you're doing is sustainable over a long period of time.
Grant, looking at setting up your particular portfolio, but not only looking at what we've spoken about today, dividend yield and dividend payout, as an investor, what else are you analyzing? What else are you looking at when you're choosing a stock?
Well, what are we looking at when we're choosing a stock? So I'll tell you what I look for and first of all, you want a portfolio that's balanced. And when Gary talks about managing the risk, you can solve for a lot of risk just by position sizing. So don't and that talks to the diversification point as well that he made. Don't put all your eggs in one basket, as they say. Don't no matter how much you love a stock, don't put too large a position in that, and you'll eliminate a lot of risk just by doing that. So things you want to look for a company that's got a good balance sheet, and by that it's not over indebted. You want to look for a company that's got good cash flow. So that means when the economy turns or things we go through a recession or a rate hiking cycle, your company's not going to come under pressure or get some sort of credit downgrade, and the business is going to really struggle and be squeezed. And sometimes that's when bankruptcies occur. You want to look for companies that can continue to grow. We talked about that. It's important that you get growth eventually in one way, shape, or form. It doesn't have to be rocket growth, but at least a reasonable amount of growth that's above inflation. Otherwise, you're really just going sideways. And you want to get good returns on the money that the business is investing, and that will come through in the growth as well. And you want a good management team. You want someone that generally delivers on what they say. If you listen to their strategic plans, if you look at how they treat shareholder capital, are they making reckless acquisitions at any price?
Yeah.
Or are they quite careful with the way they spend the money? So you want to look at, these are actually a lot of common sense in what you want to look at in a company when you're buying it. But a lot of people tend to just look for momentum. And this thing's going up, therefore I want to own it. But if you just dig a little deeper, you don't have to go that deep.
Yeah.
You have a few good checks to take a lot of risk out of the investment.
And Gary, just quickly as we wrap up, the different dates that you get for the dividend payout, a date of declaration, this is when it's announced, right? When do you actually get the money?
Yeah, so I think the key dates are the LDT, so the last day to trade. So that's the last day to trade cum dividend. So it means that if you buy the security before that date, you are going to be owed the dividend. Then you've got the ex-dividend date, which is the day after the LDT date. That's the day, if you buy the security on that date, you're not going to get the dividend. And then you get the pay date. And the pay date's normally about 2 weeks later that you actually receive the cash in your portfolio. So as long as you held it before the last day to trade, you'll be due that dividend. Even if you sell it, a week later, generally you'll still receive your cash flow, say a week after that.
And that's our investment school. Get more, of course, in our podcast, Dividend Yield and Dividend Payout with Grant Nader, Portfolio Manager at Benguela Global Fund Managers, Gary Boyson at Portfolio Manager and Director at Rand Swiss. Thank you so much.
The Money Show with Stephen Groetes is brought to you by Absa CIB, proud to support Genza Energy's investment in the infrastructure powering West Africa's growth.
Time now is 8 o'clock. That's all we had. Let's talk money tomorrow with Rainbow Chicken.